Hey dollar dreamers, welcome to this new video where we will be discussing how does supply and demand work. If you want to learn more about money and finances, make sure to hit the subscribe button and turn on notifications. Key point 1, brief history of supply and demand and its relevance in economics. First, let's talk about a brief history of supply and demand and its relevance in economics. It has a rich history that dates back to the early days of trade and commerce. The concepts emerged as economists and thinkers observed the patterns and dynamics of markets and sought to understand the forces that determine prices and quantities of products and services. The foundation of modern supply and demand theory can be traced back to the works of classical economists like Adam Smith and David Ricardo in the 18th and 19th centuries. Adam Smith's groundbreaking book, The Wealth of Nations, emphasized the importance of the invisible hand, the self-regulating nature of markets driven by supply and demand. Smith argued that individuals pursuing their self-interests in a competitive market would lead to optimal outcomes for society as a whole. David Ricardo built upon Smith's idea and introduced the concept of comparative advantage, which suggests that countries should specialize in producing products in which they have a lower opportunity cost compared to other countries. This specialization would lead to increased efficiency and global wealth creation. In the 20th century, supply and demand analysis gained further prominence with the rise of neoclassical economics. Economists such as Alfred Marshall and Leon Walras developed mathematical models to formalize the concepts of supply and demand, providing a more rigorous framework for understanding market behavior. Today, supply and demand continue to be at the core of economic analysis. The study of supply and demand allows economists to analyze how changes in factors such as prices, income, technology, and consumer preferences impact market equilibrium. It provides insights into the dynamics of markets, price determination, production decisions, and resource allocation. The relevance of supply and demand in economics extends beyond theoretical models. It has practical applications in various areas, including business strategy, policy making, and investment decisions. Understanding supply and demand dynamics enables businesses to anticipate changes in market conditions, adjust their production levels, and set prices to maximize profitability. Key point 2, explanation of the concept of supply and demand, including definitions and examples. Now let's move on to the concept of supply and demand, including definitions and examples. At its core, the concept of supply and demand refers to the relationship between the availability or supply of products or services and the desire to need or demand for them in the market. It is a fundamental principle in economics that helps explain how prices are determined and how quantities of products or services are exchanged. Supply refers to the quantity of a particular product or service that is available for purchase in the market. It is influenced by factors such as production capacity, availability of resources, technology, and the cost of production. When the supply of a product is limited, it often leads to higher prices because the demand exceeds the available quantity. For example, during a shortage of a specific commodity like oil, the limited supply leads to increased prices at the pump. On the other hand, demand represents the desire and ability of consumers to purchase a product or service. It is influenced by factors such as consumer preferences, income levels, population, marketing efforts, and price. When the demand for a product is high and exceeds the available supply, it creates a situation of scarcity, driving up prices. For instance, during a hot summer, the demand for air conditioners increases, leading to higher prices, and consumers compete to buy them. The interaction between supply and demand sets the equilibrium price and quantity in the market. The equilibrium is the point where the quantity demanded by consumers matches the quantity supplied by producers. It represents the optimal balance between supply and demand, ensuring market stability. If the price is set above the equilibrium level, it creates a surplus as the supply exceeds demand, and producers may need to lower prices to sell the excess. If you're enjoying this video and want to continue learning about money and finances, make sure to hit that like button and subscribe to our channel for more informative content. Key point 3, how individuals can leverage the principles of supply and demand to make informed financial decisions and potentially generate wealth. Now let's move on to how individuals can leverage the principles of supply and demand to make informed financial decisions and potentially generate wealth by understanding the dynamics of markets and identifying opportunities for value creation. Here's how. 1. Anticipating trends. By monitoring supply and demand factors in various markets, individuals can identify emerging trends and anticipate changes in consumer preferences. This can help them invest in sectors or assets that are likely to experience increased demand, leading to potential wealth generation. For example, recognizing the growing demand for renewable energy, an individual may invest invest in solar energy companies or related technologies. 2. Timing purchases. Understanding supply and demand dynamics enables individuals to time their purchases strategically. When the demand for a particular product or asset is low while the supply is high, prices tend to be lower, presenting an opportunity to acquire assets at a favorable price. By waiting for such situations, individuals can potentially generate wealth by purchasing assets when they are undervalued. 3. Identifying scarcity. Scarcity drives up prices as demand exceeds supply. Individuals can leverage this principle by identifying assets or resources that are scarce or becoming scarce and invest in them accordingly. For example, acquiring limited edition collectibles, rare commodities, or properties in high demand areas can potentially generate wealth as scarcity increases their value over time. 4. Analyzing market imbalances. Supply and demand imbalances can create temporary market inefficiency. Individuals who can identify and exploit these imbalances can potentially generate wealth. For instance, recognizing an oversupply of a particular stock, which has led to a price decline, can present a buying opportunity for individuals who believe the stock is undervalued and likely to recover. 5. Navigating price fluctuations. Understanding supply and demand dynamics helps individuals navigate price fluctuations and make informed decisions. By recognizing factors that impact supply and demand, such as economic indicators, technological advancements, or changing demographics, individuals can adjust their investment strategies accordingly, potentially maximizing returns and generating wealth. Key point 4. Real-life examples and case studies highlighting successful applications of supply and demand. Now let's talk about real-life examples and case studies that provide concrete evidence of how the principles of supply and demand have been successfully applied in various contexts. Here are 2 examples. 1. Housing market. The housing market is a prime example of supply and demand dynamics. When demand for housing surpasses the available supply, prices tend to rise. This can be observed during periods of rapid urbanization, or when there is a scarcity of affordable housing in a desirable location. Understanding these trends can help individuals make informed decisions when buying or selling property, maximizing their potential returns. 2. Tech gadgets. The release of new tech gadgets often showcases supply and demand dynamics. When Apple launches a new iPhone model, there is typically a surge in demand, with consumers excitedly awaiting the latest device. Apple manages the supply by initially releasing a limited quantity of iPhone, creating a sense of scarcity. This strategy, combined with effective marketing, drives up demand even further. As a result, consumers are willing to pay premium prices for the latest iPhone. Over time, as supply catches up with demand, prices may stabilize or even decrease. This cycle of supply and demand influences the pricing strategy of tech companies and demonstrates the potential for wealth generation through understanding market dynamics. These examples highlight how supply and demand analysis can inform decision-making and lead to successful outcomes. Now you have a solid understanding of how supply and demand work and how they can shape your financial success. By staying updated with market trends, conducting thorough research, and assessing supply and demand dynamics, you can make informed financial decisions and potentially generate wealth. Don't miss out on the opportunities that arise from this understanding. Subscribe to our channel for more valuable insights and strategies to help you on your journey. Thank you for watching this video on how supply and demand works. Give it a thumbs up, share it with your friends, and subscribe for more money and finance tips. We appreciate your support and look forward to helping you achieve your financial goals. See you in the next video.